Good evening, welcome back. Hong Si Pachai. Hope you guys have a great Chinese New Year. And I know it's still Chinese New Year right now. I mean, it's going to be over soon. But yeah, I hope that you guys enjoyed the first few days of Chinese New Year. And I hope you guys are also safe and healthy. Looks like the COVID case in Malaysia is dropping down. So fingers crossed it continues to improve. But that apart, I think tech stocks have been on quite a very, very hot run as of the past months, right? So, which is why we decided to go back to another tech company based in Malaysia. You probably would have followed this stock for quite some time already, and then you notice that the stock price of this company went up quite a few times, right? And yeah, today we're going to talk about D&O Green Tech, what it does, what kind of prospect it has, and what are the risks that you should actually take note of. And of course, since it's gone up so much, valuation is going to be on the high side. Does that mean you should totally stay away, or you should actually look at whether the company has plenty of room for growth in the coming months or coming years? Then only it makes sense to actually justify the high PE. Later we also take a look at the PE, what kind of PE is currently trading at. And yeah, we look forward to sharing an exciting company. Personally, we think that it's an exciting company. But yeah, before that, maybe I'll pick Jun Bing's brain. What were your thoughts going through the company? What did you like? What did you not like about the company?
I mean, later we will share it. What is the selling point behind this company? I think the key one is they are not OEM. They are not in OEM line. Basically, they are OBM. We will explain the difference between OBM versus OEM, which allow them to have more control on what they are doing, and then of course have more control on the profit margin and so on. But I think we can start today's section already. Yep.
Okay. Cool. So let's go to the main character of today's which is D&O. So as always, here's another advertisement of our upcoming event or seminar, Dividend Gems. So if you want to have a solid, foolproof framework in finding good dividend companies, this would be something we would recommend to you. Of course, this is going to be an ongoing kind of a seminar, right? But the upcoming slots in the 6th and 7th of March will be our first batch, and we plan to put a special price on the first batch offer. So it's 388 if you join for the first batch. Subsequent 2nd, 3rd, 4th batch would be 488, right? So if you want to know how to invest in good dividend companies, the right way without getting trapped, then yeah, dividend gems would be the course that you would want to look at, right? So we will post the link to sign up in the comment section. But you can also ask us any questions if you want to know. So what does dividend gems encompasses, right? So it's a complete steps and criteria to screen out good dividend companies. And you will notice that we actually split out the criteria to gauge and analyze normal companies, banks and insurance companies, and also REITs. So we also have special metrics and also KPIs to gauge certain industries and companies. And of course, one-time payment of 388 ringgit for first batch, subsequent batches 488 is a free for life course material. And during the tenure, say for example, after 1 year, 2 years, we want to upgrade the course, you get the free upgrades and it's free for life. We will not ask you or ask you to pay for anything, surcharge, any upgrades or updates on dividend gems cost for the cost of your life when you have subscribed. Be your first batch or your second batch or subsequent batches as well. So of course we will be preparing materials. We will be having a video replays and also live presentation to you guys. And once you are a subscriber of Dividend Gems, you would get access to the materials and video playbacks, and you can replay it unlimited, and you can continue to revise if you think that you want to do some revision. So that's about it for Dividend Gems. Disclaimer as always, the company that we are going to share today, it's just a sharing session, does not construe you to buy, sell, or even hold, do any kinds of decision after you go through our sharing, right? So it's just for education purposes, right? But we can still discuss it formally, but please do not actually take any advice or investment decision just because on the information based on this sharing session. So I'll pass it to Chun Beng. What is D&O Green Technologies all about? What's the business that they are in?
Okay, so I think when we talk about D&O, the key word that you should check out is actually Dominant Opto Technology Sdn Berhad. D&O stand for Dominant Opto Technology lah. So because if you go through their official website, probably you will find nothing because they are the holding company of this Dominant Opto Technology Sdn Berhad, which is the key, as in the leading LED manufacturer for global automotive industry. And this company actually established back in year 2000, but initially they didn't focus in automotive industry, but they are lighting manufacturers. Eventually they go into LED, but then they're supporting all different industry. Only starting 2016 or 2015, that few years back, they started to move their focus into it, and then finally they are able to see some of the good returns or some of the good prospect coming in due to the burst of electric vehicle and so on. And then like you can see, beside doing the LED module design and manufacturing, they also do the IC part of things, which include the design and development of it. So they are into it, not just a normal OEM company, but they are the one having the technology and also the skill to actually build LED for automotive industry. You can go to the next one, which will actually tell you the company structures. So basically, they own about 89.79% of Dominant Opto, which initially they didn't own up to this kind of percentage. It's over the year they start to acquire more and more portion of them. And then within this Dominant Opto Technologies, it's broken down into different company that consists of different sales office in different country. So if you're interested, of course, you can go through it. But then the key one is they are actually the one that holding the LED manufacturing line, actually contribute back to the investment holding company, which is D&O Green Tech. Okay, so some of you might ask lah. So what they actually does lah. So basically, they are providing LED solution for automotive industry. So this is some of the things that they provide lah in terms of application. Of course, the one that they provide the product itself is all the chip. Later we will show you some of the things. But then the key one that when it turns into an application is basically all the thing that you see here. This is inside the car itself. You got all the dashboard light, switches, reading light, and so on. Used to be using normal light, but LED is a new trend. So they are seeing an increasing trend in terms of demand for LED spec for all these kind of lighting solution within the car. If you go to the next slide, you can see the external part. So you got the LED solution for the internal. So this is the external part, which is all the typical one. You got the fog lamp, signal lighting, and so on. So this is what their product is all about. And then when they build into an application, this is the thing. Everything that you're familiar with when you're driving your car or sitting on the car. So this is all the things that's supported by them. If you go to the next slide. Okay, so this is what actually produced by them. All the different small components that actually make up the LEDs. So if you know about LEDs, right? So inside that, this is all the key components that do the lighting part of things. So I won't go into details. Of course, I'm not from this industry as well. But this basically is all the different range of product that supported the automotive industry as of now. But before that, those LED spec is more for general purpose, because ultimately LED is for lighting purpose. But now they actually switch all of these things into automotive focus, which one of the key takeaway they'll try to do is they try to actually consume lesser and lesser electricity. And personally, I believe this is the reason why behind the surging of the stock price. Because when we talk about electric city consumption, if you drive a normal car, it doesn't matter. Because normal car is powered by petrol, all those things. You can just keep on powering or charging the battery. But when you talk about electric vehicle, the electric consumption rate become very, very important. And this is also the reason why when our mobile phone, why the battery technology or electric consumption is very, very important is due to the fact that the key thing that power the entire car is actually coming from the battery, not from the petrol anymore. So this is some of the reason why D&O, Green Tech, or Dominant Opto is actually being put into the highlight recently. It's due to the rise of the electric vehicle industry. You can go to the next one. Okay, so this is some of the high-level concept on what is the difference between OBM, ODM, and OEM. So we arrange it in such a way that OBM, of course, is in the higher upper stream of thing, if you could see it that way. So OBM stands for original brand manufacturing, meaning they actually own the branding itself, and then they have the product that supported it, and ultimately they are the one manufacturing it. And then if you go one level down, they are only focusing in product level, and then they do the design, but then they do not own the brand. For example, I can produce a lot of chips, but then I let Samsung hold the brand and then sell it. And then the one at the lowest pyramid is actually OEM. So basically, they don't own any design. They just take the design from the upper stream, and then they have the factory that keep on producing the stuff. So what is the difference? Of course, the higher the level you go, the better margin or better control of technology that you have. And for D&O, Green Tech, they are at the OBM level, which is something that is very important. If you compare things like, for example, J&T, why they are so hot lately, one of the reasons is also they own the pattern and they are actually at this kind of level. They are not the OEM manufacturer, but then they are the one owning the brand and also owning the design. Can go to the next one. Okay, so this is some of the things that I mentioned. So starting 2015, they start to put a lot of focus. Actually, 2016, if you follow their annual report or whatnot, they make a very big announcement saying starting 2016 they will put all their focus into automotive industry, and then they actually uphold their work, and then maybe they are right. That's why all their share price already went up. This is the difference. So when they move from 2016 to 2017, it's actually over about 90% of their products is actually supplying to automotive players only. So this is one of the key moves from the recent 10 years. But of course, 10 years ago, like what I mentioned, they started the company back in 2000. They are focusing in normal lighting. So they make a switch from normal lighting, go to LED, and then they suffer some of the losses. If you go through their 20 years performance, they went through the bad years, but eventually they put the right bet. LED is the key for them to go in, and then they put the bet again on automotive, and this is where they are right now. So some of the history to share. Go to the next one.
Okay.
I purposely bring out this part because if you went through a lot of news articles or news reports, they will say one of the advantage for this company is actually they are very diversified. They supply to a lot of country and to different players. But unfortunately, I didn't manage to find anything from the annual reports that support with the supporting details that tell you how many come from US, how many come from Taiwan, and so on. So this is some of the other way that you can see it. So in their annual report, they actually have this section called the foreign currency exposure, meaning they have some of the asset, receivable, or investment that is in different currencies. So from here, you can see actually they are quite diversified. So they have customer starting. I mean, of course, USD can be coming from multiple country, but then they have let's say trade receivable from Europe, Korean won, Taiwan dollars, of course Malaysia ringgit, China renminbi, yen, and so on. So they are very diversified, and from this you can tell although majority of the trade receivables still in USD and also Chinese renminbi, but then they also have exposure in other part of the region. So this is one of the key things that make them not so as in more resilient if you compare to other players, because they support a lot of clients. They don't have a single client that build up, let's say, 40% or even 60% of their sales. No, it's very diversified. I think we can go to the next one. Okay, I think this one I pass back to Jupan.
Yep. So basically, as what Jun Ming said just now, this company has went through a few iterations and few, I would say, change of directions, and so far it has proven to be a good decision made, right?
Yeah.
So you can see back in 2016 where they really focused deep dive into the automotive industry kind of LED. You can see that the profit margin started to improve quite a bit. You can put it in a way that, as you see just now, whenever you buy a car, you are not just buying a vehicle to drive from point A to point B. Inside your car, there are certain functions or certain components that makes up a car, right? The tires, the engine, and the so-called mirrors as well. And of course, we will talk about the lights as well. So when you talk about lighting is such a key important component in a car. You don't only have lights in front of the car, at the side of the car, at the back of the car. You also have all kinds of light signals inside your car, light signals that tell you that your doors are not closed properly and it will light up, right? And also the dashboard, and also all kinds of light components inside your car. So when you buy a car, you're actually buying a lot of these light components, and they are vital to the so-called to make the car safe on the road to be driven, and also to find our way around. So you can see that once they went into that, it proved to be a very fruitful kind of junction. The business improved. You can see that the revenue slowly inch up, and then the profit margin, most importantly, is the profit margin, actually went up to as high as 7%. for the year 2018 and 2019. So that is one of the key changing directions of the company, and actually paid off quite well because they did such a kind of change in direction. And if you look into the latest quarter, you can see that back then in Q2, Q1, they suffered quite a bit because of the pandemic. They're one of the companies that got hit hard. The profit margin dwindled down a bit, but back in Q3 2020, it actually went back up again. And if you read their quarterly report, China, especially China, was one of the countries that got over the pandemic the fastest among the other countries, and there was a high uptake in terms of car sales. So if you want to sell more cars in China, then of course you have to buy more LED components, and D&O was one of the companies that managed to ride on the China recovery and improve their quarterly sales for Q3 2020. So straightforward, and the profit margin was around 9%, so it increased even more, right? So if you look back at the breakdown, the company is still very, very much relying on automotive LEDs. In fact, that component actually grew a lot, right? Compared to 2019 30th of September to 2020 30th of September, you can see that there is a 28% rise in the revenue. Gross profit margin, of course, further increased, so that's a good sign as well. So mainly because of some good cost expense management. And of course, other than that, I think all of the other expenses were quite flat. Just that you can see a bit of increase in the distribution expenses and all R&D expenses, but it's just by 1 point something million and also by 2 point something million compared to the so-called gross profit that they have been generating, which is a huge jump of 27 million. Yeah, so I would say it's justifiable for them to spend more for the administrative and also the R&D, just because they have done a pretty good job on growing the sales, right? And of course, that means you will see the net profit also increase by 64% year on year. So good, I would say in the right business model, producing quite good income statements and performance. So what about how the company is being run, the balance sheet, right? So we look here, straightforward, you can see if the assets is rising, means that the company is growing. They are investing the profits to growing the company. And how are they growing the company? Basically, it would be either through liabilities or debts, and a combination of the so-called equity or the retained profits generated from business itself, right? So you can see maybe one thing you might catch your eye is in the year 2019, the debt actually ballooned up to 100 million ringgit. And you dig deeper, what actually happened? Why actually there's a sudden 100 million there? Because they actually took on debt to actually undergo capex. So they actually grew the company, and you can see that not only the debt portion grew as well, the total assets also grew. So they actually borrow money and they actually invested so that the company can, grow their sales further, have more capacity to produce products to suit the growing demand of the LED in the automotive segment. So straightforward, company took on debt, and whether the debt is fully covered by the cash or not, you can see in the next one, straightforward, the cash flow statement. All this while, the company has been quite solid in the operating cash flow, raking in a lot of cash. You can see that the cash portion has been increasing, and then only at 2019 trailing 12 months, you can see the sudden downturn because the company got impacted during the pandemic. But nevertheless, if you just foresee that the company will continue to hit back the usual kind of cash flow, operating cash flow from the operation sites, or even increase because business is going to be very bullish since they are in the automotive LEDs, you would want to see them hitting somewhere above 65 million. They have to outperform. They have to rake in more operating cash flow. Then it only justifies the financing cash, the so-called interest and the loans that they are going to pay back since they took on 100+ million back then. But if you were to do it mathematically, if the company can rake in 65 million, and if the loan tenure for that 100 million is not too long or not too short, right? So it would be quite easy for them to repay one year 65. Say for example, if they took a 5-year or even 10-year loan, every year you can take 65. You can earn 65 million and then you pay back proportionately. That 100 million shouldn't be a big issue or big headache for you to actually query or get anxious, since the company suddenly took on so many debts, right? So of course, if the cash flow from the operation side got impacted by the pandemic, you will see just a temporary negative free cash flow. So the things that you want to look forward for this company is that operating cash flow to continue increasing. They have enough cash to pay back their loans, and also it somehow eventually improve and the free cash flow actually turns to a positive number lah. So last but not least, this is a company which does not just grow its business, but they also pay out dividends, right? And sometimes dividend investors would want to actually get hold of cold hard cash by being an investor of a particular company. So this company does pay out dividends, although the dividend portion is not that much lah. So historically, the company has been paying around 1 cent to half a cent for the past few years. For the past 4 years, since fiscal year 2017 until 2020, yeah, it's been ranging around there. And it really boils down to your perspective on whether you see D&O as a growth company or D&O as a dividend paying company, right? For me, it's more like a growth company because the company needs to continue to grow. Since business prospects is so good, you wouldn't want them to actually waste the cash on dividends, right? So fair choice. I would say that it's a good kind of treatment. Not paying too much dividends, just pay a bit, and then the balance gets reinvested into business. Okay, I think I will pass back to Chun Bing. He will explain a bit more on what kinds of automotive LEDs are there in the market, or what have we evolved since so many years back until 2020 and moving it forward. What kind of lighting we have been using, and what are the prospects because of the changing trend of the lighting industry, the automotive industry is actually embracing. Jimmy, you're on mute. You would need to unmute yourself.
Sorry. So I think from a year-to-year perspective, it's quite straightforward lah, because you see the demand for the lighting, which is proportionate to the demand of car, is actually increasing since 2012 from the chart that we are showing here. I think one of the key things I wanted to pull you into the highlight is actually, if you see the bar that is actually colored in green, represent the market share of LED is actually picking up. Despite, if you see the past 5 years, electric vehicle is not even a thing yet. So I would say Tesla, due to the fact the pandemic, all those things, Tesla become more and more more and more popular among a lot of people, and they also managed to actually turn into profit in certain way. Plus, the affordability of an electric vehicle also drops. So all this will drive more and more demand into LED. So of course, the result from 2020 to 2022, the forecast is actually showing some of the demand that coming from LED. But imagine if electric vehicle start to pick up, LED is the only lighting solution they will look for. They won't look for halogen or xenons. It's just consuming too much of electricity, and then they cannot afford it. So this is a very important note that we can see from a trend perspective. But it might take years to realize, even though it's very promising, you will also see that even though it's our house, maybe now most of our house are using LED, but they also take quite a number of years to actually take over the traditional pentafloor and so on. So the prospect is there, but it won't come over time. But of course, with the light of Tesla and also NIO from China and so on, and this definitely will drive electric vehicle forwards. On a side note, you also should know that China government actually subsidizing their citizens to actually buy electric vehicles. So when they buy, I don't know how much money they pay, and then certain money that can actually bear, it will be back to the government. So all this is a promising subsidies that push all these things forward. If you go to the next slide, it's another study that talk about the different type of lighting solution for automotive. Similar trend, but then for this guy, this is some forecast they put in. If you compare to 2018 to 2026, LED definitely is the one that will pick up and take over the market leader right now, which is halogen. You can go to the next one. So ultimately, the prospect behind this stock that becoming so popular, the reason behind it is because of electric vehicle that actually drive more demand for a car that use LED lighting solution. But of course, some of the key thing also you should take note why there are a lot of people coming in, because a lot of people only compare quarter Q on Q kind of performance. Need to bear in mind, their Q1 and Q2 back in FY 2020, their sales is very low. Compared historically, this is not the performance they're supposed to get. And then, of course, all these order got stuck, and then eventually it got realized in Q3 or maybe the coming Q4. So this might be one of from a 0% suddenly go to 9 something percent jump in the profit margin can be a trap. Bear in mind now the stock is already trading at about 100 over PE. I will say some of the reason come from this because they only compare quarter on quarter, which is something that we should really take note. Maybe you should see it from a yearly perspective rather than instead of seeing from quarter perspective. It can be a trap. But of course, ultimately, if you don't talk about share price, of course they are into the industry that having a lot of future prospect. This is something that definitely is a yes to me personally. But then whether it's overpriced or whatnot, you need to judge yourself.
Yep. I think not only EV are using LED, even the more premium brands like Mercedes, BMW, slowly they are also moving towards LED because it's just more energy efficient. So talking of all the prospects and the rosy outcomes that probably the so-called optimistic shareholders or retail investors want to actually bite on that to actually say that there are plenty more room and opportunity. But what about the risk of fintech?
So regardless of what is the thing they're in, I think it's very hard for them to go past maybe 10 or even 15 percentage in terms of net margin. But then the only different thing that you should see is they are into this kind of commodity. Every single car will require a lot of lighting point, down to your signal lighting. Like what Juban say, when you need to I mean, inside the car itself already got so many lighting points. Even the alert light is also one of the things that's supplied by LED. So the volume might be the one that actually help to secure their revenue or actually the net profit that come into it, the absolute amount. But in terms of margin, I think it won't be as lucrative as, for example, JFTech having about 20 to 30% kind of margin. They won't hit that. It's a bit challenging. But if you compare to other competitors that are still in halogens or xenon kind of technology, maybe, I mean, it's not maybe, they are definitely at the higher side. Another one that is a risk that I mentioned just now, it's relatively high valuation. Not only happening in this stock, I mean, the entire semiconductors industry is also very popular.
Mm-hmm.
After the case in Malaysia went back up. There was a short recovery for the normal consumer stock like bank or even tourism stock or whatnot. But then all the money coming back to semiconductor lah. So it can be quite dangerous. Bear in mind, don't compare quarter on quarter. Can be a trap because their quarter one and quarter two is really not doing well. And then it can be the order got fulfilled in Q3 itself, but they received the thing in Q1 and Q2. So this is some of the things that you should take note.
Yep. So I think one of the exciting part is, and when you actually go through everything and then you look at the valuation of the company, right? So the company is currently trading at 121 times PE ratio. Wow, mind blown. Of course, very prospective and also very hot stock. That's why when hot money flows into the stock, you see that the company is trading at a higher PE valuation. So straightforward lah. But you have to really stand back and ask yourself, how good is the business? Whether this business can continue to grow or not, and how can it grow? I think the how is very important. But that aside, if you look at the other metrics, ROE is at 8.51%. I wouldn't say too great, but not too shabby lah. Profit margin, yes, it's a bit too on the low side lah. So as Junbing mentioned, yes, LED lights are very important for car. They are everywhere inside and outside the car, but they are not the only player producing lighting solutions for automotive. So bound to have competitor, and if you go too high, yeah, that's where your competitor starts to eat into your market share lah. So it's important. It's not that easy to actually stretch their profit margin, right? So CAGR revenue growth is at 3.3%, but you may argue that say that yeah, in the future, more automotives will actually adopt using LED because of the different light intensity and also the energy efficiency, right? So that could probably grow in a faster trend compared to the trailing kind of growth. And what else? Dividend, yeah, is a 0.65 cents. The yield is 0.19%, right? And of course, this is the kind of valuation or the kind of price that you'll be paying for D&O FinTech. Should you choose to actually invest it in today's closing price. So I leave it to you guys. I think valuation is very subjective, but the business model of the company is the fact that we have to embrace, and how the company can continue to grow to justify that kind of P ratio. That one is up to our each and every one of our appetite and also our rationale to actually make a decision whether is this company suitable to invest for 5, 10, or even 1 to 2, 3 months if you are a trader down the road. And yeah, this is just the share price of the company historically. 1 year, if you look, this company has been flat, right? If you talk about tech stocks in Malaysia, I think not all of them, or I don't think any one of them actually trades like flat for the past since early last year until October. There is literally no significant appreciation in price. Right, around 90 cents, go down to 80 cents, and then all the way up to 1 ringgit. Only at the end of the year, I think around December, then you see the share price going up from 1 ringgit all the way up to 3 ringgit. So it has went up 300% really in a span of less than 6 months. So you have to ask yourself whether does this really actually justify the price or the value the company is offering? So food for thought lah. And some of you might argue, okay lah, this company might be a dividend paying company, right? So of course, we will be using some of the metrics that we actually deep dive or screen out dividend companies, right? We will run a few tests on it. Then we'll see whether D&O can be considered as a dividend company. So inside our dividend gems, there are a few hurdles. Total, there are 7 hurdles actually. So the first hurdle or the first requirement is dividend payments are non-negotiable. So you can argue with me, Johan, for the past 4 years, D&O has been paying dividends. So it can be considered a dividend company lah. Just like the yield is low, but if business continue to grow, they might pay out more dividends in the future, right? I would say yes, probably you are right. So I'll give it to you. So D&O actually passes the first hurdle of dividend gems. Dividend payments are non-negotiable. They have been paying dividends for the past 4 months, which is considered a good track record already. So consecutively 4 years they pay good dividend or decent dividends. But if you go into hurdle 2, they actually fail one of our criteria. And of course, we won't be diverging it, but I will assure you that this is the criteria that we set for dividend companies. So not only I want to see dividends, but I want to see some kind of trend in dividend. So if there's no trend there, then of course it fails the criteria, and straight away D&O Green Tech is out of the list. I will not consider D&O Green Tech as a dividend company or bet on it to become a consistent, stable dividend company for me in my portfolio. I will buy it or invest in it maybe for other reasons as a growth company. So straightforward. Not only they are just two criteria or 2 hurdles, they're actually up to 7 hurdles, right? So what we will actually teach you or show you if you sign up for Dividend Gems is that there are 7 hurdles or 7 criteria, and you will run each company, whatever company you choose, be it in Malaysia, be it in Singapore, or be it in Hong Kong, or be it in also companies in the US. Once they pass all these 7 hurdles or 7 criteria, then yes, you can actually safely assume, or not just assume, you can safely assure that they are dividend companies. Then only the headache comes is what price is suitable price to actually invest in the company. So straightforward, right? So this is the so-called basic framework to actually screen out dividend companies in a foolproof manner. This is for normal companies. The same kind of hurdle methods apply to bank, insurance company, and so REITs. So we split out different criteria because each of them operate in a slightly different manner, and there are different criteria and metrics to look at. So this is just a basic breakdown on how dividend gems actually would help you if you are into looking dividend companies the right way. Of course, we talk about tech stocks going up crazily inside our 2021 stock plus. Out of the 10 stocks with potential, I think there are a lot of tech stocks and semiconductor stocks within the Malaysia segment, which we have shared with our subscribers back in the end of January. And sometimes back then, I still remember some of the participants say that, oh, the stocks already go up by 20-30%, can still buy or not? And guess what? Now we are in the middle of February, the stocks continue to went up, and this is the kind of so-called bullish run we cannot actually predict. But what we can predict, or what we are sure that when we choose these 10 stocks, is that they were good companies, and they will actually benefit from the so-called continuous improvement or continuous demand from science and technology. So we couldn't predict that they will go up 100% or how many percent, but we just are very comfortable that this is a stock. If you are into betting or investing into the tech segment, yeah, this will be the 10 stocks that actually we are quite confident with, right? So I hope that the Stock Plus 2021 subscribers are actually happy and satisfied and confident with the so-called picks that we made. And if you want to know what these 10 stocks are, you can also sign up. Of course, the materials and also the replays are all available for your viewing and for your consumption when you actually sign up for Stock Plus as well. So I think that's about it. Thank you for hearing through the sharing for D&O Green Tech. And we will go through the Q&A sessions. Right. Okay. Okay, I think we have a few so-called comments on D&O. So great and solid company. Yeah, I think we can agree with you. The company has made a few good decisions along the way, and it has bear fruitful results. And if you have been a shareholder for more than 3 years, yeah, definitely would agree that it's a great and solid company. Oops, I think a lot of, yeah, we'll skip that. Yep. For anyone who like to get into tech stock, would it be better to buy companies with higher profit margin? Yes, I agree with you. And actually, it really also really depends on what kind of tech companies you look at. Say, for example, we have touch base or we have gone through quite a number of tech companies. Each of them have their own strengths and weaknesses, right? So if you talk about, say, for example, FP Group, right? Or even GFTech, sorry. GFTech, they have stated in their so-called annual reports that they have IPs for their test sockets, right? And these IPs are actually protecting other people from copying or even trying to infringe their so-called test socket producing designs so that they can test different kinds of ICs, right? So if you have control onto certain knowledge, technicalities, then it makes sense for you to charge a high price. So another companies that also come to my mind is Franken. They say they have a very tedious, special kind of method to help chip makers clean their so-called equipment. So they charge a high premium as well. So you can see from their profit margin is also very thick. But going towards something more commodity, like what Chun Bing say, LED, as we all know, is not something out of the world rocket science. A lot of companies out there are making LEDs. So of course, if you want to go into a mass market, commoditized products, then this is the kind of company or kind of trend that you'll be expecting. So B&O will be the kind of examples you'll be looking at if the company is just selling commoditized technological components. So I leave it to you to actually see that you want to bet on a company earning from certain IPs or bet on a company earning because the growth of the volume of a certain product is promising. So I think you have to see it from both ways.
I think one thing to bring up,
Okay.
in the semiconductor entire value chain, you have OSAT player, doing more of the assembly kind of stuff. They are, for me, they are like OEM in a way equivalent. But when we talk about LED, of course, their profit margin is lower. But then when they can go up to OBM, this is technically the best they can go, because the fact that this industry is all about volume. Volume is very high. You cannot compare this Apple to GFTech, because the amount of test socket required might not be that high compared to every single car. When they produce, they will need that. So it's a balance between volume versus the margin. But then they are able to go into OBM level, which is some of the good things compared to the other competitors that is maybe at the design level or even in the equipment manufacturing level. Yep.
True. Do you know which major car company they supply to? Any idea?
They didn't really spell it out. So I also try to find not much, don't have a lot of concrete info. But one thing that for sure is they are supporting the car manufacturer across a few countries. For example, Taiwan, Korea is the one that specifically spell out. They have an office there, and also they have trade receivable over there. So these are some of the tricks that we can find out. But what is the actual brand? They didn't really spell it out.
Yep. But I think if you just do a bit of linking back, they are only, say for example, if they have sales to Korea, there are only a few car manufacturers in Korea. So you just need to, connect the dots, do some smart linking. What else? They stated countries like the US. So US, there are a lot of car companies over there. So
big one is also China. Another big one.
China. So China. So yeah, that's I think you eventually link them back to some of the big brands in US and China and also Korea lah. Oops, no problems, Francis. Okay, can China produce LED like D&O? I think so, but anything more concrete, Jun-Bing?
I would say it's a competitive space in a way, but then they are able to conquer in such a way that they do a lot of R&D focusing in automotive industry. The key takeaway is actually the electric consumption is slightly lower. That's why they are a lot of order from different car manufacturers. So this is one of the fact. Also, I think one of the things that I wanted to share, they has been putting quite a lot of money back into R&D. Of course, they have been claiming they are doing about 5%, but if you see historically, it's about 4 to 5%. Not as high as Vitrox that spend minimum 10%, but 4 to 5 is still quite a big number. Only company that really making money and then have the urge to actually keep up with all the technology progress will do this. But because LED, they also they have got different versionings. When they go upgrade, if you didn't pick up, then you will be eliminated. So this is the reason why they spend quite a lot of money in R&D to keep them relevant into the industry.
Yeah, I think you have to look at how LED technology also evolved. Last time, the old age kind of so-called signals is always just on off kind of blinking. Now you have a lot of patterns. It can be simultaneously aligned, that kind of configuration, coordination. So all of this plays into the LED prospects and the so-called how you actually put it or actually use it on a car. So you see that the lightings on cars getting more and more savvy, more and more interesting. Some of them actually even form a certain kind of image to certain car brands because of the way they actually portray the LED configuration. So this is the kind of things that you also need to look at how LED companies fight with each other, compete with each other, not just on producing LEDs, but the light configuration as well. So big orders from China segment, is it an effect from the ongoing trade war? I don't think so. All this while, China has been one of their so-called big reliable buyers. You can see that there has been ongoing business with China. It's not just like certain companies in Malaysia, certain tech companies in Malaysia that got really benefited by the trade war. So suddenly out of the blue, they grew a lot because sudden surge in China orders coming in. So I think D&O one of the most safest bet. You can argue that because the ongoing trade war, China might take more on an ongoing basis but that one you still need to monitor, or you should need to actually follow the news and actually see in the upcoming quarters whether the China demand or China sales actually improve significantly compared to other regions as well. Okay, Kim Boon, any idea why D&O annual profit margin is lower than JHM? Let's see. I also forget what JHM do already. JHM. So let me refresh my mind, and I will just maybe do a very rough explanation on why probably JHM's profit margin is better than D&O. See if I can dig up anything. But before I dig for the answer, we can go on the upcoming questions first. Okay, let me get back to you on that, Kim Boon. We proceed first. Taking trend of growth stock as an example, trend ended when vaccines are near. How about these tech stocks, especially related to EV supply chains like D&O? Can we predict when the trend will end? No, I don't think we can predict anything can end. No one predicted growth stocks will go down this much, even though they have written so many articles on how growth usage will continue to rise. People will be more health conscious. Things we will still continue to use a lot of gloves after the pandemic whatsoever. We have seen all these kind of news, but sometimes this is how the market tries to play with us. But the thing I am more positive on tech companies compared to gloves is that glove actually went up a lot, too much already. If you just take back the so-called calculation, etc., everything, right? So it really went up a lot already. Yeah, you can argue with me that tech companies also went up a lot. But the thing about tech is not just here to stay. Tech is not here to solve a pandemic or to prevent the pandemic from becoming more serious. Tech is going to be more and more relevant 5, 10 years, 20 years, 25 years, 30 years, even down the road, if the company managed to actually, innovate, continue to improve as technology becomes more advanced, etc. So we have seen D&O is one of the very good examples. Previously, they were not even in automotive LED, but they saw an opportunity and they went into that. So the company actually improved, pivoted, and they actually went into the right improvement or the right next move, and then they are actually going. Gloves, they have been doing the same kind of products for donkey years. The only thing you can argue is that they actually improved their costs. They made thinner gloves that utilizes less latex, less rubber. So these are all the kinds of improvement that the glove company is actually tapping on, improving, and also selling more gloves. But it's a tech company that's actually enriching and improving our lives, not just in cars, but also in the many aspects that are more important to us lah. So this is what I can see. Okay, okay, I think I managed to find something about JHM. So I think JHM is about a company that is in doing precision engineering. So they do tooling, they do machining parts, they do stamping, they also do PCBA and a lot of kinds of specialized components, metal works. So if you want to actually charge your customers, customers coming to you, right? Customers are going to JHM, can you design this kind of component for me? JHM say, yes, yeah, possible, because I have the technology to actually cut, mold, shape, all these kind of materials to whatever size and to whatever configurations that you want. But it requires a price, and you have to pay this price. Do you want to pay this price or not? Then if you are the customer and you really, really need JHM's technical help to come up with this kind of parts, components, then yes, you have to pay JHM because this is something that you really need. Whereas for D&O, they are an LED company, and they are not the only LED companies out there. They might be big, they might be quite famous, supplying to various automotive companies around the world, but at the end of the day, they are not the only companies doing just LED. And that's why the business or the so-called technical knowledge the company actually can actually dictate how much they want to earn from a customer. So straightforward. JHM has more IP, more technicalities in providing services and products to its customer. Hence, there is a rationale for it to charge higher price, and you can actually see that the profit margin is higher compared to a commoditized LED component. So I hope that answers your question, Kim Boon. So who are D&O competitors? There are a lot of it. Chun Bing, do you actually have some in your mind right now?
I can share some of the name, but I don't think you guys will be familiar with it. They are listed everywhere. I mean, you can check out this company called Koito, Japanese-based company. or you can check out this company called Valeo. Koito, Koito. Valeo is Valeo. I think Valeo is from French. And then another company is Hela, from German. They're couples, to be honest. But then D&O, because you need to think of it this way, manufacturing is one thing. Once you do it, when it involve import and export, there are some costs involved. So they still need some sort of localization, whether you have similar factories locally. And then this is the one that can actually support lower down the cost. If you involve all this import and export, then the cost might come out. That's why there's always room for all these LED player to survive, because they are just focusing in a specific region. They're supporting a specific region.
Yep. One more, Osram, also quite a big LED company.
Correct.
So yeah, there are so many out there. Right. How about me? This company can have higher profit margin. Actually, we did. Yeah, I think JuJuR, you can share first.
We did a sharing on this company before. You can check out in our YouTube. Should have a replay. Their profit margin is quite high. A lot of players, when they're in precision engineering, the profit margin is very, very high. Me can be quite technical, to be honest, because the thing they do is they are some sort of machine that do sorting for the wafer, and then they have the capability to actually do some inspection and so testing. Can be quite technical. I think I won't go through it because it can be quite long. Feel free to check out our coverage on Me what is the full name already? Me Technovation.
Technovation.
Yeah.
Yep.
You check out. Maybe the financial information can be outdated, but the front part should be quite informative, sharing what is the thing that they did, and then what is the product that they have, and what is the advantage and disadvantage.
Cool. Do you have any plans to look into VSTech? Yeah, maybe one of these weeks you actually take a look at VSTech. And it could be one of the candidates for upcoming Not So Late Night show. Does D&O own patents for their products? So
they own the brand itself.
The brand.
So they are not designing the whole thing and then let someone else take their technology and brand on a white label perspective or whatnot. No, they sell their own brand. So they are OBM. Important note to take. They are not OEM or ODM. OBM is the one that can secure most of the margin.
What's D&O advantage versus China automotive LED manufacturers beyond supplying to EV? In recent years, brand names such as Osram, Philips, I think a lot of the competitor names are coming. I think the LED business, as this is not as lucrative as before. I think it really boils down to each of these companies. So if you look at Osram, Philips, and also Cree, they might have other verticals which are more lucrative to them, and it makes sense for them to actually probably not put too much effort or even exit the LED business, because as we saw just now, LED business is not the most lucrative kind of business that you actually want to look at. And for bigger companies like Osram and Philips, right, who have other more profitable verticals, it makes sense for them to actually divest it off and then let someone else actually focus on it. And they themselves, they look at the more profitable kind of business ventures or verticals that they have. But for D&O, they just got into automotive LED. The question, I think the question that you asked would be relevant to be asked also to existing investors. What is the next step or next growth frontier for D&O? They have already pivoted from non-automotive to automotive. From here onwards, can they go into something more prospective 5 to 10 years down the road. I know that automotive lightings will consider to play an important catalyst for them, but if you want the company to grow their profit margin, what else can they do? So this is a question that maybe tech investors who wants to look at the company with a higher profit margin, you want to ask this kind of questions. Why do I want to buy into DNO, or what can actually make me buy into DNO if the management were to look at something more profitable as a new vertical that can be more profitable than the current vertical that they have lah. So basically, they don't need to exceed like Osram and Philips. They just need to pivot and build a new vertical. So if the current automotive LED actually saturated, then at least there's a new vertical in place to take on the next growth frontier. So probably questions to the so-called long-term investors or the investors who want to look at DNO improving more before they actually take a bite of the company lah. So I totally will agree with you. It's not very, very competitive, and you would be right to actually ask what else can you do, or what kind of verticals can you invest in to actually grow your profit margins more. So yeah, good question, and we fully agree. What is the manufacturing percentage for its OBM, ODM, and OEM? Any idea, Junbing?
I think it's very hard to answer from a percentage wise. Of course, every if you see it clearly, OEM, they are doing 100% manufacturing, taking others people design, and then once they are done, they will pass back to them, and then they will brand it under their own brand and sell it out. OBM also do manufacturing because they own the brand, own the design, and so on. But ODM might not be the one that do the manufacturing. So it's subjective lah. But you don't know the definition on it. If later when you go back to the replay on the slide that we have shared, basically we'll know what is the thing that they does lah from a different. I mean the difference between OBM, ODM, and also OEM. So I think we have another comment saying this time of sharing they did when they have a webinar with CGS CMB lah. So one of the few ways is you are able to find out a lot of insider info if you attend their AGM, and also some of the webinar like mentioned by Nasmi. So this is just a big brand. Bear in mind, they are not the sole provider for them lah. Like what I mentioned, it's quite localized one. You have the car here. Some car is totally manufactured in German and then they import it, very expensive. But some is they have technology, they pass it to a local factory, do assembling and so on. And this is the time that probably they'll take it from local supplier. So that's why there are room for player like DNO that tackle specific regions. So all these big brands, but they are probably supporting somewhere around this region. So these are some of the key takeaway lah. Yeah.
Sure. What would you expect on the next quarter report? So I think I mentioned just now, I would want to see operating cash flow go higher than 65 million. Not on the quarterly report lah. So you just do trailing 12 months. So say for example, the upcoming is X amount, and then the X amount is times 4. You assume that no growth, but improve already. So after that, does it really improve the overall operating cash flow? If yes, then yeah, at least the company is going at the right track, right direction. Then I also want to see them using that cash flow generated from the operations to pare down their debts, and also continue their R&D expenses, and also investing into the back into the business. That means they continue to do capex, because this kind of business is volume game. If you don't earn from profit margin is impossible to go up as high as other tech companies, then yeah, you have to go by margins, go by volumes. And you want to do volumes, you have to invest in plants, equipments, and your so-called expansion. So all of these have to tie up back together, and only you can safely assure that expensive PE, but the company is geared for higher demand of sales coming in your way. Then only it makes sense to justify that maybe 100 times PE is not too bad if that kind of scenario were to pop up. So I leave it up to you to further monitor and also see whether what they achieve in the upcoming quarters comes true to what I want them to perform to lah. Next question. Off topic a bit. What are your views on Baidu? Yeah, I think Baidu is one of the leading companies in China that is going to autonomous driving and AI. So yeah, I think the only news I think I read back was that they actually have a fleet of robo taxis already. But the only downside of that news was that the cars are still traveling at quite slow speed. So fully automated taxis around the first tier cities of China, but still moving at slow speed, because if you were to go at high speed and something goes wrong with the so-called autonomous driving simulation or console, then yeah, you have some fatalities. People might get injured and die from the so-called accidents. So it's still going at slow speed, just fully autonomous, but still not fast. But I don't know, do you have any comments or not, Chun Bing, on Baidu in the autonomous driving?
I remember I read this news saying they are the one that willing making their technology open source to increase more adoption. As in, of course, you open source, you have more people coming in, then you have more data. Ultimately, this data will help to make this thing more accurate. But there is a lot more things they need to do. But ultimately, if you guys are eyeing on Baidu, they are not like Google. Beside their core business coming from the search engine, if you have been following them, they used to having a very big scandal because they allowing some fake medical ads being posted, and then they got taken action or whatnot. And then they're not like Google's, and to be frank, they have a lot of rival in China. China is a way very, very different because China got so many technology giant that feeding the information to the user, and then you might not need to actually search for it. You need product, you go for Alibaba or Jingdong or whatever big e-commerce company can get all the product you want. You want to talk about news, checking about information, they have this thing called 今日头条. Actually behind them is ByteDance, the same company that own TikTok or Douyin. This is the one that actually bring up a lot of attention away from Baidu, solely supporting their business from a search engine perspective, because the fact is they didn't manage to capture capture enough attention from the user. So this is something to take note lah. Last time, if you're following China technology news, you will heard of these terms called BAT lah, the top 3 player, which is supposed to consist of Baidu, Alibaba, and Tencent. But now there's a new guy called ByteDance take over them. Take over them already. They are ByteDance, the people who own 今日头条 and also Douyin or TikTok. Bear in mind, TikTok haven't go into public yet. And if you have been following short video kind of application, Kuaishou just got IPO and their share price has been tremendous. I mean, in the past 1 week or not. Some of the things to take note lah. Of course, they're putting their bet into the automotive industry, but it's still a lot of things to monitor.
Yep. Okay, I think one last question on Uchitech. So yeah, I think long time I never seen this company already. This company is very niche. We haven't looked into it in depth yet, in very deep dive yet. So just basically they are a company that is helping the big coffee machine brands to make the important components and etc. So they are the coffee maker kind of company. So they help companies like JuJuR, Krups, and other coffee brands to actually make their coffee machines So we might look into that. I think this is one of the so-called good companies that has been good in dividends and also in growth as well. So yeah, maybe one of these weeks we will feature them and look at them at the more detailed. Means taking up one hour of our Thursday nights to look into Uchitech and also VS Tech. So we will definitely feature these two companies in the coming weeks. And yeah, I think if there is no questions, we will actually thank you guys for actually logging in. I hope that we didn't disrupt your Chinese New Year celebrations if you are still celebrating Chinese New Year. But yeah, I think what else? No, I think just stay safe. COVID cases in Malaysia has been improving. Hope that it really drops down to 3 digits and 2 digits and etc. Things improve and we won't need to go through another lockdown again. And fingers crossed. Yeah, at least things improve for the upcoming Hari Raya, which is in May this year. So it's earlier than the usual months. So yeah, that's about it. Thank you guys. I hope you guys have a great evening and yeah, enjoy the upcoming weekend. Maybe continue your Chinese New Year celebrations. So that's about it. Thank you. We'll see you guys next Thursday, 9 to 10 p.m. as always. And thank you for actually logging in today. So bye-bye.
Bye-bye.